Ben Habib, Chief Executive and founder of First Property Group. It's a commercial property fund with more than £370 million in assets under management. Ben, hi.
Hi, Mark. Morning.
The bubble in prime property might be about to burst. Tell us how it might unfold in 2012.
Well, prime properties attracted a lot of capital over the last couple of years as people have sought to find safe havens for cash. But if you cast your mind back to as recently as 2008, 2009, prime property actually dropped in value by about 50%, and it's clawed quite a lot of that back. And the sentiment which is driving that value simply isn't borne out by the fundamentals. Yields on prime property now in the West End of London are down at 3.5%, 4% on occasion, which is comparable to gilt yields, broadly speaking.
So better to put your money in gilt yields, safer?
Well, I think the big risk, it's almost impossible having a discussion about investment strategies without thinking about the big risk at the moment, which is politicians losing control of interest rates.
Yes.
And the liquidity crisis, which seems to be on its way, could push yields up across the board on everything. And I think that's what particularly concerns me about London property.
Many gilts are down today. Yields, by the way,
yeah.
Ben, we can see the prices just there. We had Trevor Greetham on earlier from Fidelity saying, you know, the UK is a haven and gilt yields will stay low. I mean, did you buy into that argument?
Well, we've seen politicians lose control of yields now in Greece, obviously.
Exactly.
In Italy, we had a pretty poor Bundesbank sale of bunds the other day. You know, and if interest rates start creeping up, irrespective of what central banks do, you will see a repricing in commercial property. That's inevitable. And whether or not we're able to hold yields down in this country really remains to be seen, I think.
Some say London, though, you know, it's unique for all its various properties, hence it's shielded. Is that wishful thinking?
Well, yeah, that is wishful thinking. Nothing is unique. It's a special city, London. It does attract a lot of international capital. It is, to some extent, a political safe haven in these troubled times. But if you look back at the history of West End property, for example, it is one of the most volatile asset classes in the commercial property sector. The more mundane, boring side of property, the sort of retail warehousing sector, for example, has produced much higher returns over the long term than West End offices have. But it's the West End that international investors now seek.
Where do we put our money?
Well, we're putting our money into properties, very boring stuff, discount retailers, retail warehousing, ideally tenants who've taken their leases in a post-08 period, so rents have been set at a low level, and you've got strong covenants and long leases. That's what we're targeting, and we can get yields of sort of 7.5% on that sort of property, twice what you can get in central London.
The elephant in the room is the, excuse me, the sovereign debt crisis.
Yeah.
Just expand on that.
Well, it comes back to the possibility of central banks losing control of interest rates. That's where I see it. There's a lot of chat about the euro dissolving. But the key thing here for a property man is what happens to interest rates. Margins on bank debt are already very high, in fact the highest I've known them in my career. And if that were to be coupled with rising uncontrolled interest rates, I think there'd be a wholesale collapse in commercial property prices.
Poland, though, is somewhere that I know where you operate. So why is Poland such a highlight?
Well, Poland's been a tremendous economy. They're not over-leveraged like Western economies are. Their government debt, albeit pushing their constitutional ceiling, is still relatively low at 55% of GDP. The consumers in Poland are relatively unleveraged. They've got a healthy banking sector. They never dabbled in some of the more sophisticated products that our banks dabbled in. And so their real economy is doing very well. They never went into recession. They're growing at the moment at 4% per annum. That growth is forecast to slow, obviously, as a result of what's going on in Europe. But it is still a very healthy economy in which to invest.
Ben, thanks very much for joining us today.